Good afternoon, everyone. This is Brad Matheny. It's 11:30 in the morning. I should say good morning. Gonzo asked me to share my thoughts on the dollar, and my thoughts on the dollar are that I think we're going to stay within a fairly narrow range. I think that the next 5, 10 years of transitioning is going to be a dance for the the Federal Reserve, to continue to maintain monetary policy in the face of dramatic change throughout the world and dramatic change through actually debt management. So there's something we have learned, and I had learned this the hard way on my own, is that the Federal Reserve can take extraordinary actions to resolve debt issues in various ways. Prior to the or the global financial crisis, and back when I was trading, very early trading for me in the dot com bubble, back over here, um, I was under the impression that the Federal Reserve had very limited capability to handle unknowns. But after the global financial crisis and watching the Federal Reserve essentially print trillions of dollars to manage and hold massive amounts of debt throughout a growth phase in the markets seemed very odd to me. It seemed very odd that an entity itself could essentially print money to get itself out of debt and to manage extended debt factors in the market. But understand that the Federal Reserve is essentially a lender of last resort. As long as they're capable of handling the debt and printing the money theoretically for free, then all they do is increase potential inflationary trends. So we've had a fairly big inflationary trend, particularly after this period right over here, when March, April, we got into COVID. So now understand that we've gone through a very aggressive inflationary trend after this COVID bump. This is the Dow Jones, by the way. This is gold. And what I believe is happening is a transition over the next 7, 10 years, maybe longer, that is going to strengthen the US dollar and provide umpteen opportunities for asset growth until we reach a bubble peak. So now you know that I've shown you. In fact, let me pause this real quick. Okay, I found it. You know that I've shown you this chart, and this chart is an expected potential peak for the SPY or SPX 500. We could potentially get way up into a very broad peak, up in 30, 34, 35,000 up here near this center. Let me make this center screen. But what I believe is happening is that the Federal Reserve and the actions that Trump is taking, which are an essential management technique to try to move us away from extended money printing. We've got to get a handle on our debt. We've got to get to a point where we're knocking it down and we're paying it off. One way that we can get to a point where we're knocking it down and paying it off is for the Federal Reserve to move into aggressive debt buying, which means that if the Federal Reserve takes the debt and actualizes it by printing money to buy the debt, the money that they print, in theory, goes back into circulation. Whoever holds the debt gets bought out by the Fed, and the Fed then takes the debt and destroys it, meaning we don't have the debt. So theoretically, yes, we have essentially money printing issue, but we destroy the debt in the same process. That would include, in my opinion, the ability to substantially provide support for the dollar in the long run. So, in essence, that would give the Fed the ability to potentially weaken rates. We move through a contractionary period. They continue to buy the debt just like they did back here in 2007, 2008, 20, 2011, 12, 13, 14, 15, all the way up over here. Remember, the Fed was buying debt. They actualized a huge amount of debt. We can actually see it over here by coming to this Dow Jones chart and Fed debt. Oops. See if we have Fed debt, total public debt, Gross federal debt. Let's see what this is. This might have it. Interval it's not supported. Yeah. Okay. Daily 12 months. Okay, that wasn't it. So let me go over here to daily 3 months. Okay, so they've got 3 month data here. So you can see here that we have, after 2008, we started maximizing debt. Okay, and we basically ran this debt up. 2020, we ran this debt up through Biden. You can see here, this was essentially Obama up to this time frame, 142% increase in debt. And then this was Trump roughly from 16, sorry, right here, to 2020, right before. 21% increase in debt. So that's Obama. 162% increase in debt. This is Trump. Changes to red. And then we have, of course, Biden ran the debt up to here. 2024, January. There we go. Ran it up 68%. And now Trump's term took over here, and we're already up 9%. So you can see the amount of debt that we have accumulated since the 2008 global financial crisis has been extensive. And one thing that we can do to help eliminate this is A, decrease interest rates, which we have to be cautious of because of inflation. And number two, buyback. Okay, so what I want to show you, or what I want to share with you, is something I shared way back in 2020. And again, I wasn't even running this business. I was, but not super aggressively. But so we have essentially COVID. Let me come over here, draw a straight line. COVID, well, pre COVID, okay? And we have, let's call it a baseline upward growth level of approximately like this. So that's our baseline upward growth level for the economy. What happened prior to COVID was we were moving through a fairly mild growth factor. And then COVID hit and the markets collapsed into COVID. We draw that again. Going through a mild growth factor. And then COVID hit, everything collapsed. Fed started printing, and then we rallied up into a massive bubble. Okay, now, have we come off of that bubble yet? No. In my opinion, no. In my opinion, we are now at the beginning turning phase of that bubble right up here, where we're going to start to see a decline in global activity, a decline in global economic activity, and we are going to move down into a depression phase where we're going to see it decrease, wallow back up, and stabilize. Now, once we get to this stabilization point, this is where, oops, we move into a gross rally phase. So at this point, we would run into a gross rally phase, potentially having some sort of a big bubble take place. Remember, this is the Fed debt level happening. So where we're at right now, theoretically, is at the exhaustion top, moving into this, I don't want to call it depressionary, let's call it deflationary, where hard assets, homes, particularly commercial, business, and inflation trends will move into a stagnation. Now, I'm not saying it's going to collapse. What I'm saying is, -8 to maybe 10% per year while deflation continues. And that's why I think the Fed is going to move into a debt buying program while they're moving into lowering interest rates measurably over the next 4 or 5 years, which again supports this movement. So if we move into a moderate deflationary trend, we're in 2027 almost right now. We carry out about 5 or 10 years. That moves us through the topping pattern, which is the bubble, into the deflationary potential trend here prior to the big rally, which remember, this big rally could be excessive. I've drawn it fairly mild right here. This rally could be a very aggressive peak move coming back down like 1929. So I want you to understand that if the Fed is able to manage the growth by, or the deflationary cycle by maintaining moderate economic growth while certain hard assets collapse. Remember, real estate, as I've showed you back over here, is already at an excessive high. Real estate's already at an excessive high. And in theory, I believe that in order for this to move down into moderate trending, we could see moderate deflation taking place for 5 or 10 years. Okay. Now, has it happened in the past? Yeah, actually, it has. Okay. It has happened in the past. I don't know if you remember this, but after we ended up seeing this broad peak back over here in 1986, home prices were very expensive, and home prices continued to deflate downward. Where am I here? Through this downward dollar cycle into a basing pattern pretty much in 93, 94, 95, before we got into the dot com bubble. Now, what am I proposing here? I am proposing that we could be moving into, and now I want you to be aware of this. So we have the massive rally in gold while the dollar's deflating in 1979. That was the Hunt brothers chasing gold and silver. We saw the big rally on interest rates. We saw this roll back down into an extended deflationary period. That's what I believe is likely to happen over here. Now, what happened? Oops, go away, drag this over. And when I say an extended deflationary period for the dollar, I believe the dollar is going to hold above the 90 area. This has been traditional support through 2017, 2021. You can see it was resistance back over here on a weakening trend. I believe the dollar will transition into a dominant cycle through this phase and continue to appreciate through a depreciatory cycle phase. The Fed will likely move interest rates down to about 2% eventually through this cycle by easing off. Once hard assets begin to depreciate, the dollar will retain its value because once hard assets begin to depreciate, they're going to depreciate everywhere. And remember, as long as the Fed is capable of restoring order by managing debt and providing a transitionary period, you've got about a 7 to 10 year period of transition, 7 to 10 year. 7 to 10 year transition period as we cycle through this rolling trend. So we're basically rolling through this cycle trend, maybe getting slightly below that 90 area, trying to move up into an aggressive rally phase, likely building a stronger dollar out after the elections. Now, understand that we have 2028 elections coming up over here. Very, very important. You're going to find November 2028 right there. Big elections coming up. This is going to be a very important mode for the US dollar and for the global markets. Okay. We literally are kind of dancing around the edge of a cliff right now, in my opinion. And I think the Fed is capable of managing this right now. If we get into another crisis, say some sort of pandemic or some sort of crisis or financial crisis or what have you, I think we're going to be moving into an even worse case scenario, because what would happen is the Fed would likely, or through Congress spending, we would likely go into an excessive debt period, which we can't handle. And like I said, there is an alternative to this excessive debt cycle, and that is a debt destruction period. And that means that all countries throughout the world offset their debt. Basically, as I explained it to my family, imagine, let's say there's four of us, me, Lisa, Gonzo, because you asked about this, and Alex, my son. So if Alex owes me $2 and I owe him $10, we wash the two and I give him the eight, or I still owe him eight. If Lisa owes me $4, I owe her $5. We wash everything. I still owe her a dollar. If Gonzo owes me $10 and I owe him $6, then we wash the everything and he still owes me $4. Theoretically, okay, that's a debt wash. That would end up washing out a massive amount of capital off the books simply by washing the fact that if I owe you 10 and you owe me 5, we can just call it even and I owe you 5, right? That's how it works. So, my thinking is that this election period is going to be very critical. And I think we're at a point where transitionally, and I mean, I hate to say it, but I'm going to say it anyway. Transitionally, depending on where we're at moving into this election, we could move into an emergency declaration. I'm going to just put it right over here and just say that an emergency declaration could be announced related to the current shift in political climate. Okay, the Democratic communists or socialists are making a move. We have laws on the books to prevent communists from trying to take over the country. I'm getting a better feel for how this conflict, this war that may come in 2040, 2045 may play out. I think it's going to be essentially at this point, a battle between capitalists and socialists and or Islamic pressure throughout the world. We've seen a massive influx of migration from other areas of the world, Islamic and others. And I think that that pressure, just like the pendulum swings, is going to cause a pushback. Now, I'm hoping that it doesn't turn into another, crazy genocidal type scenario, but I'm getting the impression right now that the war that's coming is going to be something that's going to be more along the lines of restoring cultural sanity throughout the world. Let's just put it that way. So, what I think is going to happen is the Fed's going to move into an aggressive mode to substantiate a management process to support the dollar, probably above this 90-91 area, historically below 91-92, actually 87, which is, I'll try to mark it here with a horizontal line, 87 right there, has been a disaster for the dollar. Get below 87 and we move into a very strong weakening cycle. This would be a destruction of capital, a destruction of wealth. I don't believe that happens. I think we move into, like I mentioned to you, a meltdown phase, kind of like I mentioned over here, 8 to 10% a year. Moderate meltdown, nothing too serious. Okay, and that's exactly what happened after 1986, 87, 88. This was a moderate meltdown right here. It wasn't a disaster. It was just a moderate meltdown in asset values until we based and bottom back here, 91, 92, 93. It was not a difficult time in my view. This was right after I graduated high school back over here in 82. We had dealt with this craziness, but we didn't have this massive inflation. Well, we did, but within reason. This was back when the U.S. population was probably 220 million compared to 350 or 360 million right now. So, where do I think we're going to go? I think we're going to move into this transitioning cycle phase. I think we're going to see the Dow Jones Industrial Average skyrocket, like I mentioned to you. I think we're going to move into a cycle phase here that transitions through an up and down period and then really rallies into the war. I think this is going to be essentially the Fed managing the transition, moving into a base phase, moving into a reappreciation phase, which will be this big topping pattern right here, um, leading to a destruction phase headed into the war. So if I can redraw this, let me redraw this, drag this down. Maybe not to 200,000, but it's gonna triple. So we move into this consolidation, into this phase. I did it again. I went too high. And then out. Just like what happened in 1929. This is a big inflationary cycle phase right here that then takes 20, 30 years to recover out of this mode. What will happen to the gold? To gold? Well, gold, like I told you, in my opinion, gold, I think, is going to move up exponentially up into the 20, 30,000 range. And if I could explain it to you, we're moving through a cycle phase here, which then would stall, move higher, stall out, move higher again through this big expansion phase, stall, and then peak. And then we get into the war cycle, which could be very interesting because that could create another a massive rally phase for gold. So when a war cycle happens, you're talking about destructing wealth, hoarding gold, and hoarding gold could be a massive rally. So what do I think? Trying to tell you right now in a roundabout terms that my opinion is the Fed is going to move into a consolidation phase, managing the debt, rolling the dollar through this rolling cycle bottom, maybe getting down to 88, 86, 85, bouncing around this low, but never really getting below it. That's our low cycle right here. And then moving back into an appreciation phase, just like we see right here. That is what I think is going to happen. And I think that we're going to move into that appreciation phase here. And then we will see the dollar likely move up into the 120, 130 area through that peak. And then roll down into moderate trending as we move through this consolidation cycle. So, what would the Fed funds rate look like? The Fed funds rate would probably look like this: moderate weakening until we get into an inflationary trend here, possibly peaking out, moving downward. Ultimately, guys, the Fed should have interest rates roughly around 2.25 on average. So understand that anything above 2.25 is excessive, causing a tightening of inflation. Anything below 2.25 or at 2.25 or near 2.25 is supporting a growing economy. So we'll likely see the Feds move down through this contraction in assets into 2029. That's the election, actually. September, November. So we'll probably move down through the election, moving into a period of growth, and this is what's going to cause that big spike. So remember, when I tried to draw this here, this is actually incorrect. We're looking at rolling, and I'm going to draw this probably incorrectly, but it's very tight. Rolling into trending, into that big growth phase, down into consolidation before we break away. And again, pay attention if I come back over here, explain to you the COVID process. Capital infusion leads to excessive inflation, leads to contraction in hard assets, either fast or slow. My bet is the contraction will be slow and take 5 to 7 plus years before moving into a growth phase. Now, what you need to understand is hard assets can contract. Okay, what'll happen is BlackRock and other investors will either hold on to the houses and the commercial real estate or take their losses, take their lumps, declare bankruptcy, try to pull out of it. But really, the hard assets can continue to contract while we move into a very solid growth phase in the markets until roughly 2033, 2034, 2035. Then we move into this sideways trend. Why? Why, guys? Because this is a this is actually A, B, C, D, major E up here. But this is D1, D2. So let me try to label it here. D1, D, or actually, this should actually be E2. And this should be an E, not a D. And then this is E3. So the idea here is that we're going through an expansive contraction phase. Right now, we're moving through this contraction phase. Remember, 7 to 10 years. So what does that mean? 2027, call it 2026, 7 to 10 years puts us at 2037, 2038. Somewhere over in here, we will be ending the deflationary hard asset cycle phase, moving into a big rally phase, a big reflation phase. That leads to this massive big top. So, what I believe is happening is we're moving into that cycle trend, as I showed you right over here. We're right now, right here. Okay? This is where we're at right now. We're near this top and we're moving into this depreciating cycle phase. So here we have 2028 or 2026, call it 2026, 27. Here's a 7 to 10 year cycle moving over here, 7 to 10 years. And here becomes our, here becomes the end. Actually, this is the end, but this is where we get out of the volatility phase of our cycle phase. And then this becomes the big growth factor. Come on. This becomes the big growth factor. That is the massive growth. Okay? So, this is what I'm thinking. Now, if the Fed loses control of this cycle and or something else happens where we run into some massive scenario, then as many people have talked about before, we may be forced to dump the dollar. I hate to say it, but we may be forced to go into what's called a hard reset. And many people have talked about this before. Hard reset. That happens when essentially global finance is collapsing. Countries see no end to inflation cycle. Only answer is to destroy capital, currency, and start over. Now, have we ever had this before in the US? I don't believe so. I mean, we have had instances where we've gone through different denominations. Remember, we didn't have quote unquote dollars like we think right now when we first started. We had, government backed or militia backed or state or city backed bonds and coins. Remember, there were banks producing dollars back in the day, not the government. They were banks producing dollars. And so they were managing their own credit, just like the Fed does right now. Now, China, on the other hand, has gone through this hard reset six or seven or maybe eight times, by my knowledge. And generally, it happens as regime ends and is either replaced or let's call it refurbished in some way, shape, or form. A financial collapse is not the end of the world. It just means that paper money, tin money, for example, in China, paper money, tin money, things like that were destroyed. It all went back to hard assets: copper, silver, gold, food, weapons, hard assets, things, tangible hard assets. And you can read about the currency collapse in China. We can probably come over here and go to Google. How many? There is no exact number of the total collapse, at least four major times across imperial and modern eras: Song Dynasty, Yang Dynasty, Ming Dynasty, and Republic of China in 1948, 1949. Okay, I can tell you that based on my knowledge, there's been at least seven or eight. Okay, so you need to be aware of and I actually have written about the death rattles of the Chinese. They've gotten into such an explosive growth back over here. So I'll try to show you. So the difference between the U.S. and the world market. Okay, so for example, you've got things like U.S., UK, Japan. Trying to think of others. Canada might be included. They've been around for a while, but these are old economies, and these old economies have gone through a growth period, which is substantiated by, maybe 100 plus years, maybe 200 plus years. In the case of UK, maybe 1,000 plus years. Now, we have this ability to manage growth because we've grown through these asset inflation periods without having, a moderately high degree of risk. So you've seen this rally phase. Now, China and Southeast Asia and a lot of these other countries, they are rolling through this phase and they've been fairly flat. And then all of a sudden they went boom. And what happens in that scenario is you don't have the ability to come to baseline. So if you were to come over here and say, all right, what is the baseline for the US economy? It would be something like this. That would be, and I'll make it into a dark blue. That would be the baseline for the US economy, and I'll make this red for the Asian Chinese economy. So essentially, we have, how much do we have to move back down to baseline? All right, we have maybe 8, 9%. But wait a minute. What happens over here to the Chinese economy? Where's their baseline? Well, they've been flat for so long that if you were to run a standard deviation from this channel, you would maybe be over here. And they have, in order to move back down to baseline, they have a 30 or 40% chance of a pullback. So we have a mechanism in place, let's call it a longevity mechanism, which provides us an advantage to potentially unwind debt cycles much more aggressive than these countries that have moved into a boom cycle recently. Okay, so that's another thing that we need to consider as we move forward. So I'm going to kind of leave it there. We've been at it now for 34 minutes. I want you to understand that I do believe the dollar is going to hold up above the 92, 93 area. Rolling into this deflationary trend, I believe the Fed will take actions that are necessary to prevent any type of a major collapse. And I believe that we will transition back into a very strong dollar phase roughly in 2034, 35. Now, again, these may not be accurate. Let me come back over here. Yeah, so 20, 35, 37, 38. So if I come back here, this bottom, so let me do it with this call out, bottom 20, 35, 37, 38. Yeah, see, I've done this wrong. I'm going to have to redraw all this. Bear with me, guys. This is what happens when I look at charts and I don't look at dates. Okay. So I'll get rid of that. I'll move into the 7 to 10 year transition period. I'll make a little mark out here that 2037, 38. That's where we reach the bottom. So let me just do that with a line. That way I can get rid of them. 2037, 38. Right there. We reach the bottom. Then we reach the peak up in 2047, 48. We come up here to 2047, 48. We reach the peak. So what we're looking at is a rolling sideways trend down into this area, moving into an expansion phase, maybe up to 140, and then rolling into a collapse. That would be the dollar. Gold would likely move into a sideways rally up into 20, stalling through this contraction, rolling back up into a big phase, stalling, and then moving into a big expansion phase through this rally. Now, I would redraw that simply by telling you that if I do this right, we're going to go probably up to 14K here, up to 20 or 30, roll into sideways trending, rolling into a rally phase, and then spike. Why do we spike? Because we spike after the big collapse over here. This is the breakdown, and this is where gold typically rallies as a safe haven. So be aware. Now, the Dow Jones Industrial will likely rally, stall, rally, stall, rally into a big expansive phase, spike, roll, consolidate, and then roll out. Again, peaks and valleys may not be accurate. I'm trying to give you an example of how this will play out. And of course, the Fed funds rate will likely stall sideways into this low to maybe lower area, aggressively move higher as we try to push it into this expansion phase, trying to kill this rally or stall it, but it can't happen. And then eventually we'll peak and we'll move down into low rates trying to stop this collapse. So this is the big collapse. There's the peak. And the collapse out here, 2050, 2055, I think that's in alignment here. 2050, 2055, very much in alignment. So that gives you a pretty good understanding of where we're at. Here's the 7 to 10 year transition period, which is essentially from where we're at right here. I don't think I can draw across multiple ranges, but here, 7 to 10 year, right in that area. Here's the 7 to 10 year cycle in the Dow Jones, rolling into a rally phase before we get into a pullback. Now, what is this? This is the peak. What peak are you talking about, Brad? Right over here, 2035. So this peak is likely going to be happening right over here, 2033, 34, 35. Then we move into this congestion trend and then we rally. Move into the peak, congestion trend, then rally. There you go. And here's the congestion phase here for gold and silver. And the congestion, 7 to 10 year congestion phase, puts us with gold possibly up in the 30,000, 35,000 area. then gold will likely consolidate back down to 13, 14, 15,000, maybe before we get into a big rally where gold could just blow up. And again, here's the Fed funds rate. Now, the Fed alternately could, because in their infinite stupidity, keep rates low through this cycle until we get into this excessive phase. So we could see a low interest rate period in 2035, 36, 37, maybe starting around 2034. And that would be essentially the, I don't want to call it collapse, but if I come back over here and go back to this area, that would be this lower deflationary period right in this area. Probably the Fed moves into weakening rates right over in this low, and then keeps those rates low through this cycle phase, trying to substantiate some sort of a rally, which eventually does come into this peak, which is going to happen. And again, this is drawn not on the right time. This peak would be 2045 roughly. This peak is, or low is 2035. And this is the 7 to 10 year time frame, 2026 to 27 out here to 2035 before we get the low. Okay, so I'll come back over here, leave you with this chart. Watch this again if you have any questions. The purpose of this is to show you that you have to be aware of, what you expect to see the markets do given transition. Why do I expect the dollar to hold up better than the others? Because I believe the Fed moving aggressively to substantiate a deflationary cycle phase and to mitigate it could put the US economy as the premier economy for safety and safe haven. Whereas, as I mentioned to you back over here, remember this cycle, why are Asian markets and late stage growth markets at a much greater risk? Because the US has only a 7 or 8% contraction, maybe, to move into baseline level. Whereas all of this is built on a shadow. It's basically a house of cards. And in order to move down into this baseline level, we could see the US market roll down like this, base, and come out of it. Whereas the Asian markets and the late stage booming markets like China and others, we could see them move into a breakdown phase like this and try to come out of it. So you're looking at, a move potentially down 40, 50, 60, 70%, maybe. Whereas for the US market and the more established markets, you're looking at a move here that's maybe, 10, 12, 15%. It's going to maybe hurt, but this is just drawn hypothetically, so these numbers could be massive. When you realize the range here, these numbers are not correct. So, if we look at this, and I got to do this just so you know. So if we look at this as the low and this is the high of our charts, this move represents from here to here basically about 70%. Okay? And this move from here to here represents maybe 20%, maybe 25%. So rationally, I think the late stage growth booming economies are in for a very difficult time. And that may be what prompts a reset. Honestly, watching these economies collapse, potentially going through a hard reset, that could essentially wipe out all sort of debt. And the reason being is it's very simple. If we've got these late stage economies that are going through this cycle, rolling through this debt devaluation cycle, then we move into that big growth phase. Remember, eventually we're going to move into that massive growth phase here that comes up and tries to do something like that. Well, at that point, if we reset the cycle here and then move into a big growth phase and then get up into this big collapse, this could be reset number one, And theoretically, this could be reset number two. Why? Because the old school money, US, UK, what have you, might be able to survive this breakdown. But if these things go through, and imagine this is Asia. Asia goes through a big bubble, collapse, they go to a reset. Okay? Yep, not very happy. They go into a reset. They stabilize and then they rally and then they go into another big reset. This could be a secondary reset that essentially then forces the world to potentially move into some type of a, and I hate to say it, but US, UK, maybe Japan, maybe, let me think of one other country that could be, I mean, Japan, obviously. Canada, I mean, I would think that Canada, with its proximity to the US, would be good. But, I think that in reality, through this cycle, the ones that I would consider alternates to this would probably be Mexico, assuming they straighten up their cartel issue, and possibly Canada, simply because of the proximity of the U.S. And then lastly, I think that Africa, in some way, shape, or form, would likely be a play. Okay, why? Because of the hard assets in Africa, minerals, minerals and hard assets. Africa is, I mean, minerals and everything, they're everywhere. We have them in the U.S., we have them in Mexico, we have them all over South America, but Africa is the untouched area that could turn into a massive growth phase. So maybe some sort of a currency, balanced currency in this manner, like let's call it a currency index, where after this big collapse, we move into some currency index that is weighted, maybe like this, maybe 65% US, yeah, maybe 55, maybe 25. Do the math here, that's 70, 80, maybe. Uh, so we'll come over here and make this 20, make this 50, make this, that's 70, make this 15, and then Mexico, Africa. So this entire thing would be potentially, so 70, 85, and then another 15 year. That to me could be a basis for future economic growth where, most of the world is included. That if you take a look at that, where we have Canada, Mexico, US, UK, Japan, that's pretty much all of North America, and Africa and Europe, most of Western Europe. And assuming that we were able to stabilize some currency operation in this manner through some global index currency set up based on valuations of the economies, the GDP, and the production of these economies as we're moving, we could theoretically balance in others as well as they start to perform. So, again, this is all hypothetical. Just trying to tell you what I think is going to happen. And like I said, hope this gives you some guidance. Gonzo, thanks for asking the question. And if you don't know what I do, come over here to Ment.com. This is the member area. Let me come back over here to here. Come to Ment.com. Join Ment.com Expert Growth. It's worth it. It really is. I believe my research and my extensive analysis. Remember, I did research for a partner in Canada for, I'm going to guess, but it's going to be about 10 or 12 years. I was writing all of his research articles, delivering content, building his trading systems. I've been in the field, in the markets, developing code for people since 1989, well, 1990. I started with my first software product, the Candlestick Forecaster. And long and short of it, it takes a bit of an insight to really understand what's going on. So, how am I able to do this? How am I able to draw a chart like this and tell you, hey, what's going on? Well, long and short of it is I have a little bit of knowledge about what's likely to happen from studying past action and understanding the differences between the economy right now versus the economy in the 70s and the 80s. And a lot of people don't do that. You want to know why? Because they weren't around in the 70s and the 80s and the 90s. A lot of the people you see now were born in 90s, okay, or 85 or 88. Okay, nothing about, I'm talking about these guys, but they just haven't gone back and understood what actually took place in the 70s and the 80s. Why the global economy is so much different now than it was in the 70s and 80s. We really didn't start to connect a global economic outcome until after 9/11. So I'm going to put it as 2007, 8, 9. After the GFC crisis, we started to really connect as a global economy, and that changes the dynamics because you have a massive amount of wealth that's been created in these what I call blow up economies, simply because like China, Malaysia, other areas of the world that have just seen economic growth like you wouldn't believe. Okay, but what happens is those economies are all based on bubble mentality. When the bubble bursts, oh boy, you're going to run into some trouble. Okay, so again, come over here, visit mint.com. If you like what I do, give it a try. It's really worth it if you want to try to figure this out. I've got clients that have been with me now for 5 years or longer. Once I started this, we're focused on trying to figure out the market, figure out what's going on, and focus on my research to try to give clear, definite signals going forward. Okay, guys, that's it. Thanks again.